Okay, welcome back to Stock Market Weekly. I am your host, Evan Medeiros, for Friday, October 4th, 2024. Thanks for joining. Thanks for being here. This is the show where we break down all things financial markets through the lens of technical analysis, and there is plenty to go through this week. So let's get right into it here. First and foremost, Friday, we got our long-awaited jobs report, and it was strong, above expectations. A couple of things happened on the heels of that. Basically, the market sort of coming to terms that the Fed might actually have some things in check here, that we may not be in store for that hard landing scenario getting kind of pulled off as a low probability situation. We had yields start to move up. Couple of things off the heels, but generally speaking, a pretty good kind of comforting report, I think, for markets, at least right now, enjoying the fact that perhaps no recession, perhaps no hard landing, those types of things now entering into more of a higher probability outcome for the economy. Best week of performance for oil in 2 years. We're going to talk about that market there. China squeeze continuing. We talked about China last week, and that trade continues to work this week. Very stretched in the short term, but certainly showing lots of longer term signs of a bottom. US dollar and yields did move higher, significantly higher this week. Last week, we talked about that tight USD range, and we wanted to keep an eye on it heading into this week, and it certainly broke out and made a pretty good wave there. VIX remains bid, which is definitely interesting. We're going to talk about volatility. And oh, by the way, earnings season is back. It is around the corner here starting next week at the end of the week here with some of those financials. So stick around. Plenty to talk about. Let's get into it. All right, we are back. We've got some charts in front of us. Warden TC2000, this is the charting platform we're using throughout this video. It's a platform we support here at The Trade Risk as well. So if you head to our website, thetraderisk.com, you can see the Warden TC2000 link, and we have lots of downloads, lots of tutorials, guides, and I also work with traders one-on-one to build out custom solutions for TC2000. So if you are a technical trader, then check out TC2000. We've got a referral link in the description of this video. Check out our website. See if there's some goodies there that would help you be a better trader or investor. Let's get into the numbers here. So 1 week returns on the right-hand side, looks like a kind of a nothing sort of week here because most things were essentially flat. But I do think there are some interesting takeaways. There's a lot of takeaways, I think, from this week that we want to be paying attention to. So most of the indices were flat. If we take a look at volatility here, you can see that it was up across the board. Now, one of the things that we did not put in our top takeaway slide just from a moment ago was we did have geopolitical tensions really sort of ratcheting up this week. So we had some attacks from Iran earlier in the week that the market certainly reacted to and was on edge with the VIX kind of climbing intra-week there, and things kind of settled back down. But the market is clearly paying attention to overseas just consequences over there. And so that's one thing I think is keeping the market a little bit on edge or at least bid on volatility just based on the developments over there. But if we take a look at the VIX here going out at 18.63, Nasdaq vol is over 20, so 21.5 here. Both were up about 1 point this week. Now, if we take a look at sectors here, you can see that it was a very split kind of market this week, and we had energy, which really just sort of romped and stomped everything else. Again, we talked about crude oil having one of its best weeks in a couple of years. Well, you certainly got the benefit there for XLE exposure, which is energy. Financials, utilities rounded out the second and third spot, both up about 1%. Now, on the downside, it was staples, materials, real estate. Those were the three heaviest hit here. Remember, real estate was starting to really get its act together. It's been getting its act together, not just recently. It had been performing well, but now it's starting to see a little of that wind come out of the sail, I think, with the sort of knee-jerk reaction higher on interest rates, certainly affecting that rate-sensitive sector. Now, if we take a look here at our trend filter, so this is one of the custom indicators that we built for this platform, which is available on our website, you can see that we are kind of getting more of the same here. It's still a fairly split market. We did get some new buy signals printed, for instance, in technology again on Friday. Now, again, it's not coming off of a sell signal or anything like that, but it was a little neutral throughout most of this week. If we take a look at energy here, you can see finally getting a fresh buy signal here, kind of the first time. I mean, there's been a couple of false starts throughout the last few months, but energy has been broadly down and choppy. And so this is going to be an interesting test here. If XLE is finally turning the corner, it seems like there's some good momentum occurring here as you see some separation in these green dots. So that's constructive to see. But really, if we, take a look at some of these other sectors of the market, we have some of our tried and true winners here. XLI continues to trend nicely. XLY, consumer discretionary, continues to trend nicely. Same thing with utilities, which I can't find down here, continues to trend very nicely. So a little bit of changing of the guard here, I'd say, with energy starting to perk back up, but more of the same in terms of what we've seen in this market environment. This is our relative strength view here. You're kind of seeing, again, similar picture here of relative strength versus the S&P 500 across our individual sectors. Now, let's get even further behind the hood here and take a look at market breadth. 52-week highs and lows, that's one of my favorite to look at on a week-by-week basis. And you still see true dominance here in the number of stocks hitting 52-week highs versus 52-week lows. Again, this is always sort of, a good arbiter of truth here. There's lots of noise out there sometimes when price action gets choppy. It's tough to discern price action. I always like to kind of resort back to what's underneath the hood, what's breadth showing me from a bigger picture 52-week high and low level. And we can still see that we are getting more issues hitting 52-week highs than we are 52-week lows. In fact, you could see, even with some of the turbulence we saw earlier in the week, we really didn't get any big flare up of stocks hitting 52-week lows. So for me, again, evidence is still in the bullish camp here. That hasn't changed, and so I'm going to stick with that and look to be optimistic on this market. Now, let's make a pit stop here for Investors Business Daily. They are a sponsor of this show, so thank you, IBD, for making the show possible. This is their top 10 of their top IBD 50 list. We've got a link in the description of this video. You can get access yourself to this list. It updates every single day. There's also some other goodies in this subscription, so check it out with a link in the description of this video. Now let's move on to a pretty interesting slide here. So this is our macro view here, and we're looking on the right hand side at the US dollar, and we're looking on the bottom at the 10-year treasury yield. And so the dollar was in this very tight trading range that we talked about last week, and that clearly resolved itself to the upside. And this is now throwing a wrench in the series of lower highs and lower lows pattern that we've had in place here for the US dollar. Much the same for the 10-year treasury yield. I mean, both of these are going to move pretty much hand in hand most of the time, or at least in this market regime. And for the 10-year treasury yield, we saw a big push up. This is coming on the heels mostly of this jobs report on Friday, but you can see now that we had this nice series of lower lows, lower highs in the 10-year, and now that's starting to get disrupted again. So this is going to be something to pay attention to pretty closely here. We don't want to see rates, really running away and surging, right? There's clearly a steepener trade sort of happening here if you're looking across the different maturities. But generally speaking, this pattern, the 10-year, still is in kind of a downward trajectory here over the last several months. We're going to see if that can persist. We've got a counter trend move right now, and it's a little bit stretched in the short term. So we're going to want to keep an eye on interest rates here. We don't want them to get too out of whack here, especially for some of those more growth appetite type names. If we take a look here at commodities, you can see oil again up 8.65% this week. It's now up positive, pretty much that for the last 1 month. Silver was up nicely. That's been very constructive looking there. Gold was flat. I mean, it's had a huge run though. Copper was flat basically, and Bitcoin was down this week about 5%, still up nicely over the past 1 month. So let's get into some individual price action here. Let's take a look at the S&P 500. This is a weekly chart now, and here we go with a little bit of turbulence on this week's wick. You can see that. Let's go to the SPX. So you can see, even though we had some turbulence this week, we did end up closing strong, and we are right back to those prior all-time highs. We did close at weekly closing highs for the S&P 500. Let's go to the daily chart right now, and you can see that this was the range we talked about last week here as things were getting a little bit kind of sleepy, grinding sideways. It looked like the bears could maybe take a shot at this market, and they did Tuesday, and this was off the heels of, unfortunately, some of the geopolitical actions that we saw overseas. But the markets did stabilize here on Wednesday, Thursday. There was not any more panic, or things, thankfully, from a war perspective, did not escalate. And so the market kind of held in there on Wednesday and Thursday, treaded water, and then the jobs report really was the catalyst to push this market back up. So for the S&P 500, remember last week we talked, this yellow line right here on this chart is what we talked about as sort of a line in the sand for the market. Look, if you want to be aggressively short, or if you want to take a shot on the short side or reduce exposure on the long side, this was the area where I wanted to see the market break below, and we didn't get there. We got real close to it, and we found support pretty much exactly where you'd want to find support. So all we had this week was basically digestion, a test of a fairly important area here in the S&P 500, approximately the July highs, and some prior range of trading here in late August. And dip buyers kind of stepped in here, and markets squeezed up. So on the S&P 500, there really isn't anything new to talk about here. We have an existing uptrend that is in place. We're now consolidating at highs. I still want to pay very close attention to this line in the sand here, which is approximately now this week's lows. If we are above that line, then I want to be participating in this market. I want to be looking at things from increasing exposure, looking for breakout setups, looking for stocks to rotate into, and continue to play for further upside. If we start losing, call it 56.75, 56.80, 80, then things get a little more dicey, right? Then there's some cause for concern as some near-term technical damage, and then potentially losing those July highs. But until and if that happens, I do think this market wants to move higher here. If we take a look at the Nasdaq 100 again, you've got digestion this week occurring. You had Tuesday of kind of a breakdown day for the market, down 1.4%. We put on an inside day. We went sideways again, and then we shot up here after the jobs report. So if this turns into a little bit of a bull flag consolidation that launches us and gets us back up towards the prior July highs, then this is certainly going to be still a constructive market. Notice, of course, though, the Qs are not at all-time highs, so that relative sort of divergence there, that relative underperformance, still kind of playing out. There are better spots to be right now than technology, even though, full disclosure, I have a position in the Qs. We've had a position in the Qs for most of this year. So we do have a position here in TQQ in our Galahad trading system, but it's not the spot of strong momentum, at least at this time. Okay, Russell 2000, I still think this is a case I made last week, is that it's kind of the best looking in my book here. Best looking in terms of reward to risk, right? S&P 500 is clearly at highs. That looks great. Dow Jones is clearly at highs. It looks great. I don't necessarily see a massive parabolic move that could happen here in either of those markets. I think a grinding higher could still happen. I do think there's a lot more potential for a squeeze to happen here of a more substantial nature in the Russell 2000. That's why I like the prospects of the trade. So for the Russell 2000, look, it's not ready per se yet. It's still kind of carving out some consolidation here, but the structure looks pretty decent. Again, weekly chart, take a look here as it's taking its time, chewing through a lot of this multi-year ago supply in this 2021 range, but it's trying to put in these higher highs, higher lows. I will say that the Russell 2000 held in there pretty good on Friday. 1.4% up in the face of such steepening yields with rates rising as much as they did on Friday, the dollar breaking out. That generally speaking would put some pressure on small cap kind of growth appetite type names like this. And it really held in there and did pretty well. So I'd be waiting and watching for some follow through here in the Russell 2000. If this can start to, break over 222, let's call it, then I think you get some kind of a squeeze momentum play that could happen. Ultimately, you got to get back over 225, the prior cycle highs here from July, to really get this trade in motion. But Russell 2000, don't sleep on it. I still think it's an interesting spot to be. Saw a slight uptick here in dollar volume on Friday. So pay attention to that. Again, Russell 2000's got a lot of financials in there. There's energy, there's biotech. So these are the types of things that are, really getting a little more steam nowadays, and not necessarily just big cap tech. So that I think is interesting. Let's move over to the VIX, because the VIX here is staying bid, like we talked about. Going into the end of the day, this is 19. What did we say at the beginning here? Okay, yeah, the VIX is going out at 19. Maybe that updated throughout this video. I thought I read a lower number. But a 19 VIX still shows a little bit of caution out there, right? That's a pretty elevated number for an S&P 500 that is basically at all-time highs, right? So there is clearly some fear in the market. I think, again, some of those geopolitical tensions. We've got the elections obviously coming up, and then we have earnings season coming up. So I think this is really a very hallmark case here of the market sort of climbing the wall of worry. There is clear reasons to be concerned, yet markets continue to kind of grind and ratchet higher, and they fail to break down. That's at least the case we have right now, until hopefully not one of those shoes drop. Hopefully it's not on the geopolitical side, but until and if something changes a little more dramatically here with price action, it seems like the markets are really climbing this wall of worry. So that's what I want to say about the VIX here. It's elevated, notably elevated, and let's just keep an eye on it. If it starts really screaming, north of 2021 and getting some momentum there, then I think we have some things to be maybe concerned about. But for now, market up at highs, VIX is bid. Right now, I think I would classify that as really sort of climbing the wall of worry. Now, if we take a look at some other individual sectors, so energy, again, this was the big standout winner. Take a look at the dollar volume coming through this week. So big kind of surge here as XLE starts to break out of this consolidation. Take a look at the weekly chart here. Again, big week, 6.8%, heavy dollar volume coming in here, moving back up towards kind of a breakout of this range potential. It's not quite at all-time highs, but certainly, again, trying to resolve this range here. So, looks good here. I mean, it looks like it wants to break and make a more convincing move. We need to see some more follow through here. We need to see if we can come in next week and still catch a bid and add some gains here. But XLE, certainly technically, they're starting to do some work and break out. Financial, same thing this week. So again, they've been basing at highs, kind of looks like the S&P 500, right? But the last couple of weeks here, it's been choppy. It's been digesting. It had a nice run up here in August, and then it's now taken basically the month of September to go sideways, to consolidate, to digest those gains. And this was a nice kind of breakout gap here on Friday. And so if we get some more follow through, XLF, again, just a great place technically to be right now, and it looks pretty actionable. It's not the most sexy high beta names, but it's certainly names that can grind and continue to compound here over the coming weeks. And utilities, I mean, you really just don't get a trend as persistent and low volatility as you do here in XLU. This thing looks like a fixed income, chart, but it is, and it's not that far off, but it is just grinding up here, continues to work. And if we look at a weekly chart here, again, you can just see a very persistent, consistent winner here for XLU. So that is certainly where a lot of the strength is right now. If we take a look again at XLK, I mean, we just looked at the QQQ. It's fine, right? But it's just not the place that has just a lot of, rotation going into it. And in fact, if we take a look here at the Mag 7 stocks, I think this is kind of interesting here. So if we look at the weekly performance of the Mag 7 this week, it was mixed, which is, more or less fine. But just take a look at these charts here, right? Take a look at Microsoft. Take a look at Nvidia here, Google continues to be, both, all of these are kind of in consolidation mode on a more intermediate term basis. The only standout here is Meta. Take a look at Meta, at how much it is crushing everything else right now, and even over the last month. I mean, Nvidia is doing well as well, but Meta is now at all-time highs again. It's up 5% this week, and it's really kind of separating itself from the pack right now. So most of the Mag 7 is in consolidation mode. Tesla's getting its act together as well, but Meta continues to work, and I think that's certainly interesting. So that, I think, is just about everything that I had to talk about here. Lots of things developing on the front. There's going to be lots to talk about over the coming weeks with the election, with earnings season now quickly approaching here. Jobs report, again, looking like the market is saying no recession is likely, or at least it's not the high likelihood scenario. 25 basis point cut is probably the most likely going into November. So these are some of the new developments that are happening, and it seems like stocks outside of technology are what's driving us higher. So that's what I have. Let me know your thoughts in the comments below. Hopefully you had a good week trading out there. As always, we appreciate you tuning in every Friday for long form market analysis just like this. We've got links in the description of the show to our own TC2000 downloads, to our newsletter, to our trading systems, to our sponsor IBD. Lots of stuff in the description. So thank you so much. As always, we'll see you back here next Friday. Take care. Have a great weekend, and we'll see you in the next update.